Jake bought the property. Marcus bought the index fund. Same age, same city, same $90,000 salary, same $75,000 in savings. Same goal, become wealthy without gambling their future. Jake believes he made the smarter move because he can walk into his investment, touch the walls, collect rent, and watch someone else help pay down his mortgage. Marcus thinks Jake is making life unnecessarily complicated. He puts his money into a low-cost index fund, checks the account occasionally, and gets on with his life. They both think they made the smarter choice. They're both wrong, because when you run the full numbers, the gap between these two strategies isn't obvious in year one. It isn't even obvious in year three. The really interesting part happens after you account for leverage, taxes, maintenance, vacancy, mortgage interest, appreciation, compounding, and the opportunity cost of the money sitting inside the property. And by the time we reach the longer checkpoints, the answer won't look anything like the argument you hear online. So let's make this fair. Jake and Marcus are both 35 years old. They live in the same city. They each earn $90,000 a year and have exactly $75,000 available to invest. No inheritance, no family money, no special access to a property deal. Jake chooses real estate. Marcus chooses an index fund. And we're going to give both strategies the same starting pile of money and track what actually happens. Jake finds a $300,000 rental property. He puts down 20%, which is $60,000. Closing costs, inspections, lender fees, and prepaid expenses cost another $9,000, leaving him with $6,000 in cash reserves. The remaining $240,000 is financed over 30 years. For our example, we'll use a 67% mortgage rate. That's close to Freddie Mac's August 13, 2026 average 30-year fixed mortgage rate of 67%. Freddie Mac, 1. That creates a principal and interest payment of roughly $1,544 a month. The property rents for $2,500 a month. Sounds great already, but this is where most real estate comparisons quietly stop. And that's exactly where ours starts. Jake has property taxes of about $3,600 a year. Insurance costs $1,500. Maintenance averages $3,000. Vacancy costs roughly $1,500. Property management, if he doesn't want a second job, costs about $2,400. That's $12,000 a year in expenses before the mortgage. The property produces $30,000 in annual rent. Subtract the $12,000 operating costs and the roughly $18,527 mortgage payments, and Jake is actually about $527 negative in the first year. Not catastrophic, but not passive income either. Now look at Marcus. He takes his entire $75,000 and puts it into a broad stock market index fund. We're going to use an 8% annual return as an illustration, not a promise. No tenant, no leaking roof, no property tax bill, no vacancy, no mortgage, no contractor calling him on Saturday morning. Just $75,000 compounding. And immediately you can see why this argument gets so emotional. Jake has an actual building. Marcus has a number on a screen. Jake can tell his friends, "I own a rental property." Marcus says, "I own an index fund." One sounds like an asset, the other sounds like a spreadsheet. But feelings and math are two very different things. So let's start the clock. At the end of year one, Marcus's $75,000 index fund, growing at our assumed 8%, becomes about $81,000. Jake's property appreciates by our assumed 5%. The $300,000 property becomes $310,500. His mortgage balance falls from $240,000 to about $237,403. So Jake now has about $73,097 of equity in the property. Add his remaining $6,000 reserve and subtract the roughly $527 negative cash flow, and his financial position is about $78,570. Marcus has $81,000. Marcus is ahead by about $2,430. And if someone stopped the comparison right there, they'd probably say, "See? Index funds win." But we're 1 year into a 20-year decision. That's like judging a marathon after the first mile. Year 3 gets more interesting. Marcus's $75,000 at 8% is now worth about $94,478. Jake's property, appreciating at 3.5% annually, is now worth about $332,589. His mortgage balance has fallen to roughly $234,627. That gives him about $97,962 in property equity. Add the $6,000 reserve and the cumulative rental cash flow, which is roughly negative $219 by this point under our assumptions, and Jake is sitting around $103,743. Now the scoreboard has flipped. Jake is ahead of Marcus by about $9,265. Notice what happened. Marcus's investment grew without borrowing. Jake's investment grew partly because he controlled a $300,000 asset with $60,000 of his own money. That's leverage. And leverage is the hidden engine behind why real estate can look incredibly powerful. But leverage cuts both ways. If that property falls 10%, the $300,000 asset loses $30,000. Jake didn't invest $300,000 of his own money. He invested roughly $69,000 after the down payment and closing costs, while controlling a much larger asset. So a $30,000 decline represents a brutal hit to his equity. That's the part the real estate always wins crowd doesn't put in the thumbnail. Now we reach year 5. Marcus has $75,000 compounded at 8%. That's about $110,200. Jake's property has grown to approximately $355,918. His mortgage balance is down to about $231,660, so his property equity is around $124,258. His cumulative rental cash flow has now turned positive, reaching roughly $1,980 under our assumptions. Add the $6,000 reserve, and Jake's position is about $132,238. That's roughly $22,039 more than Marcus. And this is the first point where the leverage starts becoming impossible to ignore. Jake didn't need the property to appreciate by 8%. He only needed the entire $300,000 asset to appreciate by 5%. A 5% increase on $300,000 is $10,500. Marcus needs an 8% increase on $75,000 to make $6,000. That's the mathematical reason real estate can accelerate wealth when the numbers cooperate. But don't celebrate yet. Because Jake didn't get that $10,500 for free. He paid interest, he paid taxes, he paid insurance, he paid maintenance, he accepted vacancy risk. He accepted the possibility of a major repair. And he tied a large amount of his financial life to one physical asset in one location. On paper, that's $10,500 of appreciation. Sounds great until you subtract everything else. And there's another number sitting underneath Jake's property that almost nobody talks about. The $240,000 mortgage. At 67%, the interest portion is enormous during the early years. In year 1 alone, Jake's mortgage payments total roughly $18,527, but only about $2,597 of that reduces the loan principal. The rest is interest. That means when Jake looks at his property and says, it's worth $10,500 more than last year, that isn't the same thing as saying he earned $10,500 in spendable wealth. The property is worth more, the mortgage is still there, the expenses are still there. And the money Jake put into the deal can't be simultaneously earning an index fund return somewhere else. That's opportunity cost. Marcus has a different problem. His investment is liquid, but his balance can fall dramatically without warning. If the market drops 20%, Marcus's $110,200 at year 5 could temporarily fall to about $88,160. Jake can look at his property and see a building that hasn't changed much. Marcus opens an account and sees tens of thousands of dollars disappear on a screen. That's psychologically harder than most people admit, and this is where the comparison becomes much more interesting, because so far, Jake has the advantage from leverage. Marcus has the advantage from simplicity, liquidity, and lower friction. Neither strategy has won the full race yet. The next checkpoint is where the hidden costs start getting much harder to ignore, because a property that looks like a $355,918 asset on paper is carrying an entire ecosystem of expenses underneath it. And once those layers enter the calculation, the question stops being, which investment is better? It becomes, which investor is better equipped to handle the investment they chose? Now we hit year 10. Marcus has left his $75,000 index fund alone. At an assumed 8% annual return, it's now worth about $161,910. No additional contributions, no leverage, no tenants, just compounding. Jake's property, growing at 3-5% a year, is now worth about $423,026. His mortgage balance has fallen to roughly $218,700. So the property itself gives him about $204,326 in equity. Add the accumulated rental cash flow and his $6,000 reserve, and we're around $219,000 of net financial value before selling costs and taxes. That sounds like a decisive victory. But now we have to ask a much less exciting question. What would Jake actually keep if he sold? A real estate investor doesn't get to keep the headline value of the property. If he sells for $423,026, a 6% selling cost assumption would remove about $25,382. Pay off the roughly $218,700 mortgage, and he's left with around $178,944 before taxes. That's a very different number from $423,026. On paper, that's $423,026. Sounds great until you subtract everything else. And that's the pattern we're going to keep seeing. The flashy number is usually the gross number. The useful number is the number you can actually keep. Now look at Marcus. If his index fund is worth $161,910, there's no real estate agent taking 6%. There's no roof replacement. There's no vacancy. There's no closing statement with a dozen different deductions. But there is one major issue: taxes. If Marcus sold the investment, the gain would be roughly $86,910, depending on his tax situation and the type of account. Some of that gain could be taxable. Jake also has taxes to consider, but real estate has a different set of rules, including depreciation and potentially different treatment when the property is sold. That's why the comparison can't simply be 8% versus 3-5%. The tax structure matters, the financing matters, the holding period matters, and the behavior of the investor matters. Now let's expose the hidden layers underneath Jake's property. First is vacancy. A rental doesn't produce $2,500 every month simply because the listing says $2,500. One vacant month costs Jake $2,500. 2 months cost $5,000. A 5-year period with just 3 vacant months costs $7,500 in lost rent. That's not an accounting trick. That's money that never arrived. Then there's maintenance. A $3,000 annual maintenance assumption sounds reasonable until the water heater fails for $1,500. The HVAC needs $4,000 of work, or the roof suddenly needs $12,000. If Jake averages $3,000 a year, that's $30,000 over 10 years, and averages are dangerous. You don't get a $3,000 maintenance bill every year. You might get $800 one year, $1,400 the next, and then an $11,000 disaster in year 8. That's why cash reserves matter. Then there's property management. At 8% of rent, Jake is giving up about $200 a month on a $2,500 rental. That's $2,400 a year. Over 10 years, that's $24,000. If Jake manages the property himself, he can keep that money. But he's not making it disappear. He's paying with time. Then there's insurance and property tax. Our example uses about $1,500 of insurance and $3,600 of property taxes in the first year. If those costs rise 3% annually, the year 10 bills won't look anything like year 1. And then there's CapEx. That's the expensive stuff that doesn't happen every month, but eventually happens anyway. Roof, HVAC, appliances, plumbing, exterior repairs. A reasonable long-term reserve might easily run $2,000 to $4,000 per year for a property like this, depending on its age and condition. That's another $20,000 to $40,000 over 10 years. The property didn't become a bad investment because these costs exist. The mistake is pretending they don't. Now let's look at year 20. This is where compounding becomes dangerous to ignore. Marcus's original $75,000 at 8% becomes approximately $349,464. Jake's $300,000 property at 5% becomes approximately $597,000. His mortgage balance, assuming the same loan terms and regular payments, is down to roughly $141,000, so his gross equity is around $456,000. Add accumulated cash flow and reserves, and the headline net worth could approach roughly $470,000 before selling costs and taxes. So does that mean real estate wins? Not automatically, because Marcus's $349,464 required no leverage. Jake's $470,000 came from controlling a $300,000 asset with borrowed money and accepting decades of operational risk. Now imagine Jake sells. At a 6% transaction cost, approximately $35,800 disappears immediately. After paying off the roughly $141,000 mortgage, he's left with around $293,000 before taxes. Suddenly, the comparison is much closer. Jake could still be ahead, but he isn't ahead by the size of the property value headline, and that's the number everyone brags about. Your house is worth $597,000. Okay, how much of that $597,000 is actually yours? How much would you keep after the mortgage? How much after selling costs? How much after taxes? How much did you spend maintaining it for 20 years? How much did your vacancy cost? How much did your insurance increase? How much did your property taxes increase? And most importantly, what would that $69,000 of original capital have become if it had been invested differently? That's the real comparison. If I only showed you the downsides of real estate, I'd be doing what every anti-real estate influencer does. Real estate has genuine advantages. The first is leverage. Jake controlled a $300,000 asset with roughly $69,000 of upfront capital. Marcus controlled $75,000 of stock. That difference can produce enormous results when property values rise. The second is rent. A tenant can help fund the mortgage. Marcus's index fund doesn't send him a monthly check to cover his loan payment. The third is control. Jake can improve the property. He can renovate. He can increase rent. He can reduce expenses. He has influence over the asset's performance. Marcus can't call Apple and tell them to increase the stock price. And the fourth is tax treatment. Real estate can offer deductions and depreciation rules that don't work the same way as a regular taxable brokerage account. But here's where the losing option can actually win. Suppose the property rents for only $1,800 instead of $2,500. Now the rent-to-price ratio is dramatically weaker. Jake's mortgage hasn't changed, taxes haven't changed, insurance hasn't changed. But the income has fallen by $700 a month or $8,400 a year. That can completely destroy the cash flow advantage. Second, suppose the property needs $25,000 of repairs in the first 2 years. The leverage that looked brilliant suddenly becomes a cash flow problem. Third, suppose Marcus has a 20-year horizon but needs access to his money in year 7. His index fund can be sold in seconds during market hours. Jake can't sell a bedroom. He has to sell the entire property, wait through negotiations, inspections, financing, and closing. Real estate is less liquid. That's not an opinion. That's how the asset works. And fourth, location matters. If Jake buys in a market where prices rise only 1% annually while Marcus's portfolio compounds at 8%, leverage won't magically fix a weak asset. Now let's pull the two strategies together. Our example isn't designed to prove that every index fund beats every rental. It proves something much more useful. The result is extremely sensitive to the assumptions. Change the mortgage rate. Change the rent. Change appreciation from 5% to 2%. Change vacancy from 5% to 8%. Change maintenance from $3,000 to $6,000. Change the selling cost. Change the tax treatment. Change the index fund return. The winner can change. And that's why copying someone else's investment strategy is dangerous. Now let's ground this in actual market data. Freddie Mac reported the average 30-year fixed mortgage rate at 67% on August 13, 2026. That matters because borrowing isn't free. A higher mortgage rate increases the amount of return a leveraged property has to generate just to keep pace. And on the stock side, the long-run history of broad U.S. equities shows why compounding can be powerful, but also why an assumed 8% return should never be treated as a guaranteed yearly outcome. One year could be strongly positive. Another could be sharply negative. The average is not the path. The path is volatile. So here's the practical way to make this decision. Step 1. Calculate the property as a business, not as a house. Start with gross annual rent, then subtract vacancy. Subtract property taxes, subtract insurance, subtract maintenance, subtract CapEx, subtract management, subtract mortgage payments. Then calculate the actual cash flow. If the property only works because you ignored 3 of those costs, it doesn't work. Step 2. Calculate the return on your actual cash invested. Don't compare a property's 5% appreciation to an index fund's 8% return. Compare the growth in your equity and cash flow against the amount of your own money you committed. That's the leverage calculation. Step 3. Run the opportunity cost test. Take the money Jake puts into the deal. Ask what happens if that money instead compounds in a diversified index fund for 10, 15, or 20 years. Then run the real estate scenario under conservative base and optimistic assumptions. If real estate only wins under the optimistic scenario, you don't have a great investment, you have a great story, and stories don't pay mortgages. Now go back to Jake and Marcus. Jake walked away from the first 5 years thinking he'd found the smarter path. He had a property, he had leverage, he could see the asset. Marcus walked away thinking he had chosen the boring path. He had a brokerage account, no tenants, no keys, no rental checks, just numbers moving up and down. But 20 years later, neither one could honestly claim the other strategy was stupid. Jake had potentially built more equity because leverage magnified the growth of the property. Marcus had built substantial wealth without taking on a mortgage, vacancy risk, maintenance risk, or the concentration of owning one property. They both thought they made the smart play. Neither one actually ran the full numbers before choosing. And that's the real lesson. The real trap isn't index funds or real estate. The real trap is making the decision based on hype, headlines, or someone else's opinion instead of running the numbers for your own situation. Because the investment that makes your neighbor rich might be completely wrong for you. And the boring investment sitting quietly in your account might outperform the exciting one once you include every dollar. Or it might not. That's why you calculate. If you're wondering what happens when you combine both strategies, using real estate for leverage and index funds for liquidity and diversification, that's a completely different conversation. Because sometimes the answer isn't choosing one side. Sometimes the answer is deciding how much of each actually makes sense. Jake and Marcus didn't need another opinion. They needed a spreadsheet. And you don't need another financial influencer telling you what to buy. You need the full math. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Money Mindset Lab and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.